The diversity of real estate investing is real, and it offers a flexibility that most investments, if not any investment on the planet, can ever offer you. We're going to talk about this tomorrow as you get prepared for our new Real Estate Advantage live event on January 17th. We have thousands of people registered. We have an arena, a small arena full of people that will be there. And I'm really excited to see you there because Scott and I and the entire Keyspire team have put a lot of time and effort and months of work into getting this ready for you. We've got 3 hours, we've got 4 speakers, and we are going to get you prepared for 2026. I promise you that. You are going to leave the event prepared for what to do next in 2026, as early as what to do next within a few days or within a week. You're going to have your next steps. You are going to understand what we are up against here in 2026 and why now is an amazing advantage for people that do the right things. So let's get you prepared here in this quick video. I want to talk about the 3 categories of diversity that real estate offer. Now, there's 3 general ways where people get into real estate. You've got active income, passive income, and portfolio income. So we focus a lot, and tomorrow we'll focus on the active income. But I wanted to give you this like high level of what the different ways to invest are, so that you know to focus in on what we're going to talk about tomorrow, and then how we build that plan. Portfolio income is similar to like the stock market. Only in the way where you're investing, you put your money in, and it's completely out of your hands in somebody else's management, their assets under management. The main differences are it's real estate. It's not just intangible pieces of paper or stock. Not that there's not some great stocks out there, but real estate, we can touch it. And for us that are real estate believers, that's what we really like about real estate. The second difference for portfolio investing in real estate is it's in the private markets. So you are insulated from the ups and downs, the day-to-day ups and downs of a quick trading environment like the stock market. So that's portfolio income. Then we get into passive income in real estate. And, I like to actually call this less active income because there's still some work to do, but it's not as much work to do as active income. Passive income would be something like purchasing a buy and hold rental property and having a property manager take care of it for you. There's still some work to do, but you don't necessarily have to show up every day like you might show up to your job every day. There's also stabilized real estate I would put under passive income. Say you buy a property and you fix it up and then you rent it out for the next 5, 10, or 20 years to create that cash flow. That would be a stabilized piece of property that would be in the passive income category. Remember, there's still some things to do. It's not like portfolio income where it's completely under someone else's management. You are managing the concept of the property, but you may hire a property manager to be the person that has to go out day to day and do those things that you don't want to. So that's the passive category. And then we have active real estate, active investing. And this is the way where you're going to make the most amount of money in the shortest period of time. And it's often where people start in real estate investing, especially if you're looking to increase your income, increase your cash. Say you're working and you want to supplement some of your income with real estate income, or if you eventually want to leave your job and you want to completely replace your job income with cash and income from your real estate portfolio, you're going to start with active income. And the way I want you to think about your progress through this ecosystem is starting with active income. And then when you're ready, you put some of that into passive income. And then when you're ready, you put some of that into portfolio income. So we'll often build a 3-month, a 12-month, a 5-year, 10-year plan for our clients. We're going to talk a little bit about that tomorrow, what that plan looks like. So that plan really helps, is your roadmap for your entire real estate investing journey. So let's talk about active income for a moment, because that's where a lot of you may be starting. And we're really going to focus on helping you with that active income at the new Real Estate Advantage. What does 2026 bring for active income investors? So you can build that nest egg and start to move into passive investing and start to move into the portfolio-based investing. Well, the 2 main exits for active income, or the 2 main functions, would be a fix and flip or a buy and hold rental property. All right. You're going to get it rented out, get it stabilized, and move it into passive. And I think everyone's familiar with a fix and flip. You buy a property, you put in some money, do some renovations, and then the property is worth more than the purchase price plus the amount of money that you invested. That's the concept anyway. You want to increase the value more than the amount of money that you put in. That's your profit margin. That's why you're in business, in order to increase value, just like any business. And so with a fix and flip, you're going to buy the property, you're going to increase the value, and then you're going to flip it to someone else. And you're going to flip it to a buyer, and they're going to pay you money, and you're going to get your cash in hand. You'll pay your taxes on that, and you'll be left with a pool of cash at the end. Not a terrible strategy, but what Scott and I learned early on is this secondary strategy called flip to yourself. Flip to yourself is absolutely amazing. I'm not going to say I invented it, because the richest people have been doing this for thousands of years. As soon as commercially you could buy real estate, increase the value to property, and then resell property or get property values loaned on, you could get a loan on a property value. That happened thousands of years ago, and people have been using this strategy. When Scott and I discovered it, it was around the year 2000, over 25 years ago, and we've been doing it ever since. And we've been doing it for our clients ever since. We've been showing you how to do that. So what is flip to yourself? In flip to yourself, you're going to do all the first 90% of flipping a property. You're going to buy a property, you're going to increase the value, and now it's going to be worth more. And if you do your math right and you follow our system, it's going to be worth more than the money that you put in. That's the idea. You want to have a profit when you run your business, right? You got to have a profit. You got to buy wholesale and sell retail. And so the only difference with flip to yourself, instead of selling it to somebody else, all right, you've already done all of the hard work and you sell it to somebody else. Instead of selling it to someone else with a flip, you are going to refinance the property. You are going to get a loan for 80% loan to value of that new amount. That loan is going to allow you to take out some equity, and that equity is going to cover the amount of money that you put in. And that's how we like to run the math, is the equity covers the amount of money that you put in. So you can have a property, you do the work, active investing, right? You're going to go in, you got to do the work, you do the flip to yourself strategy. And if the math works out and it's done right, then you are left at the end of the day with a property that you own 20% equity in, and you have tenants rented to tenants, and they're paying you every single month, and you have no money actually in the property. There's no cash, no investment that is left in that property, and that just grows and grows and grows. And then you go through the investor life cycle. You take that cash, that original cash that came out from the refinance, and you could go buy another property and do it again and again and again. We call this recycling your down payment, taking one down payment and using it over and over and over again. That is flip to yourself. It is taking all of the economics of flipping, but instead of taking your hard work and selling it to someone else so they get a rental property for the next 20 years, you are essentially flipping it to yourself by refinancing it. You're taking out the cash that you put in, and you get to keep that income stream for the next 5, 10, 15, 20 years. Forever. You can pass that on to your kids. You can pass that on to the people that you want to, because you have now an income stream for life. Look, the first book we wrote was called Cash Flow for Life, and it's no accident that real estate gives you that cash flow for life. But you have to have the right strategies, and this flip to yourself methodology is very important. Now, why do I tell you that? Is because 2026 is perfect for flip to yourself. We are back to the economics where flip to yourself works the best based on where the market is in the market cycle. We're going to talk about that on January 17th. Based on the top 10 markets all across the country, we're going to talk about those on January 17th. Based on the exact value-added renovations you have to do in order to increase the value more than the money you put in. We're going to talk about that on January 17th. So I want to make sure that you show up excited, prepared, and ready to do some work tomorrow, because we are going to cover a lot, and you are going to leave tomorrow's event with a completely different outlook on what it means to be a real estate investor, and most importantly, with a refreshed confidence and clarity on what you are to do next. So I hope that was helpful. We're going to talk about flip to yourself tomorrow, and we're going to talk about all the economics that lead up to it. Make sure you show up. Make sure you're there. We start at 11 a.m. Eastern. Come about 10 minutes early to make sure that you get in the room, because with technology, sometimes thousands of people, it takes a little time to get in. So I will see you there tomorrow. We're going to have a lot of fun. It's going to be absolutely amazing. We're pumped. Have a great night. I'll see you there. Be prepared.